Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is trading covered calls and short puts. And this morning as I was preparing for this webcast, I was thinking, I'll bet there's somebody out there saying, Cameron, so you teach this webcast series called Covered Calls and Short Puts. Stop being coy about it. Why don't you just get right to the bottom line? Which one's the better strategy? It's actually a great question, and I think I have a very good answer to that question. We're going to be doing a side-by-side comparison of these two strategies. I think there are going to be some revelations in there for just about everybody. Great topic. I'm looking forward to getting into that in just a moment. Before we can address that, let me first of all say hello to everybody who's already chatting in out there. Hello there, Dragon Rider 108, Selva, Eva, John, David, Dom, Ricebird, Scott, Mighty Mouse, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion if you'd like to be here. This is a Monday webcast series. We do it every Monday. The markets are open and things kick off promptly at 2 Eastern time. We'd love to have you here in the live stream audience. And I also want to let my current live stream audience know that my very good friend Barb Armstrong is hanging out in the chats there. She's already addressing questions that are coming in, and Barb's just going to be covering any questions that I can't get to just during the flow of the presentation, as long as they're not too far off topic. Barb's there to pick up my slack, so thanks for being there, Barb. And Barb and I would also like to issue an invitation for you. Barb has already linked in the chats our handles on X. If you have an X account, or in other words, if you have an account on the platform known as X, make sure that you're following your favorite presenters there. You can follow Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. All right, so let's start to get into this discussion, comparative discussion, covered calls versus short puts. And of course, as we go to that, we first need to consider the risks associated with trading strategies, whatever they might be. This is important information, so bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and Schwab does not recommend the use of technical analysis as the sole means of investment research. Finally, any investment decision you make in your self-directed account is solely your responsibility. So let's get into this discussion. Here's what we're going to be doing with our 45 minutes together. First of all, first thing that we're going to do is take a look at our existing positions for this webcast series. We tend to build up positions as examples to illustrate these concepts. So we're going to go have a look at those existing positions. 5 of them we need to review. Then we're going to take a quick peek at the markets. Yep, John. And John, I'm not going to go too deeply into why the markets are doing what they're doing. I might keep it more at a technical perspective. I do know that Kevin Horner and crew covered that pretty nicely in this morning's Trader Talk. So you might want to check out that webcast. But in any case, yeah, we're going to take a peek at the markets. Then we're going to use an example trade scenario to weigh a covered call against a short put. And we're going to place a trade at the end here to at least demonstrate one of those strategies. So really looking forward to this one. Let's go right to our existing positions. This is on the Thinkorswim desktop software trading platform. This is software that can be downloaded from within your Schwab Online account for free. You just go to the Trade tab and you'll see in the drop-down menu, look for Thinkorswim. You can download it right there. But here are 4 positions. I said there were 5. Actually, I wanted to start things off. We'll come back to these 4 in just a moment. But we had a trade that we were placing last week. We placed a short put, or at least we placed a short put order. And what I discovered after the fact, because I closed up the webcast, I moved on with my day, and I came back and looked, and that thing did not fill. So last week, what we noted was that it appeared that Procter & Gamble was moving through a price ceiling. We were right here, closing just or moving toward closing just above this broken resistance. So we took a bullish position, sold a put, and you can see what PG has done since then. So turns out, in retrospect, at least so far, not such a bad idea. However, notice my label here. We attempted to sell a 21st of March 167.5 put. tried to get $1.50 out of that. It was trading, or actually tried for $1.55. That didn't fill. I lowered that to 150. That didn't fill. And now I think that that's trading. If we go, so that was the 21st of March, 167.5. But if we just want to go beat ourselves up for not getting a fill on that, and we go to the 21st of March for PG, and we look at the 167.5 puts, how much are those trading for? About 50-ish cents. Yeah, we'd already be 2/3 of the way to maximum gain on that trade. So ouch. But let's put that one in the rearview mirror. In any case, that does illustrate a risk of limit orders. Sometimes limit orders don't fill, especially if you put them in and you leave them alone and they expire at the end of the day, which is what happened to this one. So we also do have existing positions on AbbVie, IBM, Wells Fargo, and XOM. So with AbbVie, we bought 100 shares on February 3rd. Let me close that up. We sold a 210 call a little bit later on February 24th. So here's what that looks like. So notice, bought those shares for 190.71, then sold a 210 call. If we look at that on a chart, I sort of just draw in some lines to help us understand what's going on here. We bought the shares right back here as price had made a strong move above a resistance. It's not difficult to reconfigure or reconstruct the logic of this bullish entry. A trader might have been looking at this and saying, well, we just pushed through a pretty strong price ceiling. We're getting a strong bullish candle off of that price ceiling. So we bought the shares, did not enter the covered call just yet. Instead, just retained the shares. And then the shares rallied up to a resistance level up here, what appeared to be a resistance level. So at that point, we sold a 210 call on this day. That was the 24th of February, with the preference there for price to sure continue to rally, but hopefully to stay below 210. Now, if we wind up getting called for 210, that means that we sell the shares that we bought for 190-ish for 210. That would be a $20 profit on the calls. A $20 profit on the stock, in addition to the premium collected for selling the calls. But right now, that trade is actually doing just fine, up $1,700 on that position. We're going to leave that one alone. However, it has gone a little bit in the money. And as we go in the money on short options, that elevates the risk of early assignment. The risk of early assignment is always present, even on an out-of-the-money contract, just as we go in the money, and especially if we get closer to expiration while in the money, that can dial up that risk. Mark says, your order was filled? I don't know why mine didn't fill. I'd have to go back and have a look, Mark. Yep. That didn't fill. All right, so with IBM, we bought 100 shares, sold a 265 call, both those on the same day. So if we go back and look at this, let's look at our chart there. This is another trade. It's doing fine. We bought shares as price, once again, it had gapped up, pulled back down to the bottom side of that gap, and here the trader might be thinking, looks like there's a decent price floor here at the top side of that gap. We actually entered the stock position here and sold a call right up at these previous highs. And interestingly enough, stock ran up to those previous highs and has pulled back from those, and we're pretty much down to what we paid for the shares. So the shares, we're making a little bit of money. The call is, it's working its way toward expiration, but net between those two positions, see, we sold the call for $2. It's worth about $1.40. So going in the right direction. Bought the shares for $2.49. They're worth about $2.52. Net profitable on that trade. So we're going to leave that one to work. With Wells Fargo, another covered call, bought 100 shares, sold the 80 call. So here's what that trade looked like. So here we put ourselves in the shoes of a trader who had maybe purchased shares back here. We were having a discussion about using calls as a potential exit. So part of that discussion was selling one call in the money. Another part of that discussion was selling another call out of the money on a different stock. So this is the one where we sold it a little bit out of the money. So putting ourselves in the shoes of a trader who purchased shares for $70, and then looking at this rallying up to about 77.5, we actually sold a call at 80. This went in the money a little bit temporarily, but it's pulled back since then, and we're back down right in the neighborhood of that previous resistance. But overall, That trade's working out fine. This call is just working its way toward expiration. Let's see if we get there. We're out of the money. Assignment risk is lowered, early assignment risk, but it's still present. Now, finally, pardon my throat, we have shares of XOM. Bought some shares, sold the 115 call. With this, we prefer for the stock to go up, which it has a little bit. Bought at 107-ish. Now it's at 108-ish. So the shares are doing okay. That call, though, interestingly, sold it for $1.20. It's only 39 cents at this point. So we're about 2/3 of the way to maximum gain here on the call. That's an unrealized gain at this point. Let's go look at XOM. So here's where we bought the stock. It rallied up to resistance. We actually sold the call on this date when it looked like we were hovering below that resistance, sold this 115 call. And you can see it struggled to get above that resistance since then. And actually today, not a good day at all for XOM. That's pulling back. So what might a trader consider doing here? Well, if they think this is the beginning of the end for the stock for a while, if the stock is likely to sell off, maybe they look to get out of the stock. And if they don't want a naked call position, maybe buy that call back. We could buy it back essentially for pennies on the dollar, probably at this point. Or if they think this is, maybe this is going to come back down to support, we don't mind holding on, maybe sell another call, we could possibly do that. I think for today, just to keep the focus on the discussion that I want to have today and to provide plenty of time for that, I'm not going to make any changes to this position. But some might look at taking this opportunity to close out this call that only has 38.5 cents left in it-ish, about 40 cents maybe. If they're worried about the stock losing money, losing value dramatically, maybe they just close the whole thing and settle for $223-ish profit, depending on what they might be able to exit for. But I'm just going to leave that alone. Okay, we'll come back and revisit that, maybe talk about possibly rolling it next week, depending on circumstances. But right now, markets aren't doing so well, but net, our 4 positions are doing fine. Kind of wish that PG had filled. So congratulations there. Was it Steve that said? No. Who said there? Oh, Mark. Mark said their order had filled. Yeah, but in any case, we'll come back. I say congratulations to Mark. Paper money, real money, I don't want to know. And also, things can change. We have to be aware of that, right? But let's go have this discussion about covered calls versus short puts. And to set the stage for that, I do want to have a look at what's going on with the S&P 500. It's kind of a rough day, down a little less than 1% today. But we tack that on to the sell-off from the all-time highs back here a couple of weeks ago, and we're down a fair percentage. I haven't run the numbers specifically today, but what is it, about 4% down? Something like that. I'm sort of eyeballing things there. Might be a little bit more, might be a little bit less. But what does that imply about the trend for the S&P 500 from that technical point of view? Well, some traders might think this is just sort of a pullback back down to a support area. We can see that the S&P sometimes goes for these strong runs upward, and then as profits take us back, maybe that opens up a new value opportunity and prices run up again. But on a few occasions, we've pulled back down to an apparent trend line here. And really, we haven't spent much time below that trend line at all year. So for some, for some bulls out there, they might be taking heart from that. But also, there is a recent price floor. Recent is now stretching on into 4 months that previously acted as a resistance level. So that might add some additional technical consolation to those bulls who are worried about things. Now, could we break on down and go on down further? Certainly could. But for today, we're going to put ourselves in the shoes of a trader who is trying to decide, I'm going to put on an income-oriented strategy like a short put or a covered call. They're trying to decide between those two, but at least maybe they've determined, looks like, based on this technical outlook, maybe the S&P rallies and goes up from here. Time will tell. But let's say that we're planning a new trade out here for April 18th, that third Friday of April. We already have plenty of contracts expiring on the 21st of March, so let's roll this one out to April and look at an example there. And the example that I'm going to use for today's trade is going to be Apple. All right, let me get rid of this drawing here. It's not going to play into this discussion, but let's say that our technical income trader here, they feel okay about the S&P 500 for its possible signs of bullishness. And then they look at Apple, and they notice Apple's been largely channeling, trying to work its way higher. But in recent weeks, it looks like it's pushed through an area that has previously acted as a pretty good price ceiling, while the price floors seem to be rising. And so they might expect from here, or maybe they think that Apple is going to hold above that floor around that 237, 238 level. Maybe they think we're likely to go higher from here. So one thing I do want to point out, I pointed this out a couple of days ago, the long tail on this candle from Friday is not terribly accurate. Every once in a while, you get an anomaly that comes through on the quote feed from the data providers that provide the quotes to a chart. And what I noted as I looked at a very short-term chart, let me go to like a 5-day, 5-minute chart. Do you see this right here? It's kind of hard to see as we transition from the overnight hours to the, from the overnight hours to the normal daily hours. We had this big long tail on a 5-minute candle. That was actually just one single quote. That was a misprint on the quote feed that caused this sort of false long wick on that candle. But I wanted that context here as we're looking at this. This actually never did go, I closed that out. Hold on a second. Let me just quit this. There we go. Anyway, our support area really has not been violated by that long tail on that candle. That's kind of a ghost tail, right? Anyway, so let's just say that our trader thinks that the price is going to go up. And they've decided, I'm going to choose between, Mark, you said that candle from Friday was worrying you. Yeah, that's why I hope that was helpful there, Mark. Yeah, looking at the tick by tick in those circumstances, if we see that all the trading is up here except for one anomaly way, way down below, literally one print, yep, almost certainly that's just a misquote. Anyway, so let's say our trader is trying to decide between a covered call and a short put. Sounds like an important decision. I'm going to do a side-by-side comparison. Let's go to our trade tab. Let's just say that we're going to buy some shares of Apple right now. I'm going to outline trade A, which is going to be a covered call, versus trade B, which is going to be our short put. We're going to do a comparison of some very important elements of these two different strategies. So it looks like our stock is trading right now at 241. So shares, let's jot this down as quickly as I can before prices change. 241, and maybe we sell with shares at 241. Let's say we go to the 245 strike. It looks like it's trading between 395 and 4. So I'm just going to write that down and I'll fill that back out. Let's just say we sell that for 395. I'll get back and fill that out a little bit more. But let's also look at the puts. They're trading between 725 and it will look like about 735, maybe 740. Let's say we're able to sell that for 735. That's going to be our trade B. Sell the 21st of March. That was the 245 put for 735. Now, you notice why I did that so quickly. I want these to be, I want to capture a moment in time. If I talk about the covered call for 15 minutes and then talk about the put, the numbers will have changed. So it's not a really fair comparison. What I want to compare is how do these things look at a given moment in time. Okay, so let's see. That was going to be selling the 21st of March. What you'll notice is I chose the same strike because I want this to be a true, as close as I can make it, apples to apples comparison. So let's say we're deciding between doing this covered call and selling the 21st of March 245 call, or same expiration, same strike, and hopefully Same moment in time, so it's as fair a comparison as I can, selling the put. So I want to break this down first. Let's do trade A, our covered call. There are some important considerations for traders. This might not be an exhaustive list, but I tried to make it about as complete as I could. Ted says, is today's doji on the Apple chart a possible warning sign? Dojis are, just a quick comment there, Ted, just indecision. Doesn't really tell the trader typically a lot. Might just mean hesitation before a move up. It might mean hesitation before a move down. Typically, what a candlestick trader will look for is what happens the next day. Yeah. Let's see. Oh no, Chuck, I did say that, didn't I? Apples to apple. We're comparing apple to apple, right? Chuck, that was a good one. I missed it. Yep. Anyway, let's look at some of the elements of the trade. So again, we're just talking about the covered call. We'll circle back now that we have frozen the put in time. We're not going to pay attention to what's going on over here anymore because it's going to change. But first of all, our covered call, what is its bias for the stock? Is it a bullish trade or is it a bearish trade? It is a bullish trade. We own shares of stock. Yes, we've sold a call and put a cap on how much those shares can potentially make for a period of time, but still there's a bullish bias. If the stock collapses in value, there's a lot of downside risk in a covered call. So the bias here is bullish. That's important to understand. Number two is that with a covered call, we did have to buy the shares, thus making this a covered position. If we buy shares, there is an ownership requirement to this strategy, right? Okay, I can just sort of state that as a fact. That's an element of a covered call. Third element that we need to understand, how much can we make on this trade? The theoretical maximum gain on this trade. And maybe it'll help to go to our charts and sort of break this down. Let me remove this drawing and this one. But let's say that we bought our stock at right here at about 241, and we sold the call. Let's put that right above today's candle and draw that in out through April expiration. There we go. Well, when we sell a call, we have an obligation. Somebody has the right to buy shares from us for 245. So if the shares go rocketing up, that's nice. We can make some of that potentially, but above 245, someone else has the right to buy those shares at 245. So there is a limited maximum gain. Let's do the math on this. Gazelle says, why wouldn't you consider a long call vertical? We could, but my webcast series isn't called Verticals. I do teach a webcast series on Thursdays called Long Verticals and Diagonals. So yeah, maybe join that if you want to see a discussion of those sorts of strategies. In this one, though, we limit ourselves just to the discussion and the trading of covered calls and short puts. Okay? All right. So very good question. But our theoretical maximum gain on this trade is, well, if we bought the shares at 241, they're on the move, they're going up, but we theoretically bought our shares at 241. If we have to sell those shares at 245, according to the terms of the contract, that would be, if the contract is assigned, a $4 gain on the stock, plus we collected $3.95 on the call, and that puts a cap, theoretically, at $7.95 on this covered call. Gazelle saying, which would have a better ROI? Yep, we need to do that sort of comparison, don't we? Well, so this is how much our maximum gain is, $7.95. Did everybody follow that logic? Buy the shares at 241. If we have to sell them at 245, it's $4 max, for which we were paid $3.95. So combine that together, $7.95 is the theoretical maximum gain. What is the theoretical maximum loss? Well, if we bought the shares for 241 and they plummet to zero, we lost $241. Right? Now, how likely is that loss? That strikes me as being highly unlikely. Is it still just within the realm of possibility that Apple, one of the largest companies in the world, at some point in the next how many days? Let's see. Did I do 21st of March? Oh, I hurried. Oh, well. Yeah, I was going to do this for April. Sorry about that. We'll just do it. We'll stick with March. That's okay. Whatever. Let me just edit this drawing though, just to be sure. Let's activate that drawing and pull that over here just to get the expiration correct. That's okay. Anyway, so how likely is it that the company, Apple, goes bankrupt between now and 18 days from now? It's probably not terribly likely. I think we can all say that. But we still have to acknowledge that is the worst case scenario in this trade. That's the theoretical maximum loss. If we lose $241 on the shares, and someone has the right to bail us out, say, hey, Cameron, you know what? Maybe I'll just buy the shares from you for the $245 that my contract says I can. They're not going to do that unless they really get at some bizarre wild hair. They leave us stuck with the Credi shares we bought. But we do have a little consolation prize here, $395, that sort of compensates a little bit for this loss. So that reduces the loss by $395. And that takes our maximum loss down to, what is that, $237.05? If I get any of my math incorrect, just let me know. $237.05. It's almost $4 below what we paid, just not quite. Whew. All right. Let's see. Bob says, for theoretical maximum loss on covered calls, shouldn't you also factor in the premium for the covered call? Exactly, Bob. Yep, that's what we just did. Yeah. So that's our theoretical maximum loss. That's interestingly also our break-even point. If you're really trying to understand what we're getting ourselves into with covered calls, the break-even point is equivalent to the maximum loss. Let me talk about it this way. Let's say we own our shares at $241, and between now and expiration, 18 days from now, the stock drops $3.95. Now we have an unrealized loss on the stock of $3.95 versus the $3.95 premium that we were paid to get into the call, and maybe that just expires worthless. If it's out of the money, which it would be in that scenario, the contract just expires worthless, that's a wash. So the break even is also $237.05. All right. Well, if we can lose $237, here's another thing I want to talk about. Let's say that we are doing this trading in our IRA or cash account requirement, or a cash account. We want to understand how much cash do we need to do this trade? Well, in an IRA, if you can lose $237 a share, you got to have $237 a share. You've already invested it. Yeah. The cash requirement, just to see this, if I were to go place this trade, let's see, it was a 245. Let me right click on this. Let's buy a covered stock. And for just a moment, I'm going to hide this left column. If there's 237.05 that can be lost, if I click confirm and send, yep, $23,705 is going to be the amount of cash tied up in this trade. That's really just the difference between buying the shares and the premium collected. All right, so that's going to be $23,705. Okay, so what you may have noticed on that trade is there's also a commission. Assuming one contract, we're not paying commissions on the shares, but there is a commission to be paid on the contract. That was 65 cents in this example trade. You notice I want to break this down as much as we can, get all the facts of the trade so we can do a really fair comparison. All right, so if $7.95 is how much we can make, and 237 is how much we can lose, what are the probabilities of these things happening? Or 237 is how much, or is the break-even level? What's the probability of that occurring? Well, let's talk about the fun part first. What's the likelihood that we actually make the full $7.95 that this trade can possibly make? Well, a gauge here is just to look at our delta. Delta has a couple of potential uses for options traders. That some traders will use it, they'll take a glance at it, and it'll tell them how much they might make or lose on an option trade based on a $1 move in the underlying security. So 42 cents made or lost on a $1 move up or down. But another thing is, they might look at that, the probability of being in the money at expiration. 245 has a 42% chance of being in the money. In other words, there's about a 42% probability that we're at maximum gain at expiration. What's the probability of maximum loss? That Apple falls and we lose $237.05. That is almost zero. Let's just do it this way. Let's do it in percentages. I can't say it's zero, even though it sounds extremely unlikely that you might say to yourself, there's no way Apple's going to go bankrupt the next 18 days. You never know. It could always be something, some, shenanigans behind the scenes. Who knows what might do that? But, yeah, almost zero. But what about break even? What's the chance that we're below 237 or at 237.05? Well, I can actually go to my analyze risk profile for Apple. Not risk profile. Let's go to the probability analysis. And I can just go to the 21st of March and go up to 237.05. And that's about as close as I get. It's about a 61% probability that this trade, you see what I'm doing? The crosshairs that I'm showing here, the number above those crosshairs, 6144 in faint gray, tells me there's about a 61% probability of this trade. It's not where I wanted it. I want it on the break even. Okay. Yeah, Eva says, so true about the possibility of Apple going bankrupt. Teeny chance, but remote. Remote, but still within that realm of possibility. Anyway, I think we're pretty good. Oh, one other thing that I wanted to talk about. I want to talk about expiration. What if we're above, I'm going to change that in just a second. Let's go over here to our chart here. So here's our strike price, pushing out to the third Friday of March, the 21st of March. What happens at expiration, with rare exceptions, if we are above our strike at that expiration? Well, if somebody has the right to buy shares from us for $245 and the shares are up here at $250, they're saying, hey, Cameron, I got a discount. I get to buy the shares from you for less than they're worth. Yeah, those contracts get assigned with very rare exceptions. Those contracts are in the money, and all in the money contracts are exercised or assigned at expiration unless there's an explicit do not exercise order left. So if we're above our strike at expiration, we're at maximum gain, but we have no stock. Our stock is sold. All right? In other words, it's called out. What if we're below the strike at expiration? Well, let's say we're down here at 240. We could be down at 230 or 220, just below our strike at expiration. Well, the trader who has the right to buy shares from us, probably not going to do it. They're going to say, Cameron, I'm not going to pay you $245 for shares that are only worth $240, and they're gone. So then we still own our shares. We still have that premium, but we came up a little bit short of maximum gain. So we are below maximum gain to some extent, could even be in a loss territory, but I'm just going to describe that as below maximum gain. but we still own the stock. That is a lot of deets, a lot of details regarding this covered call. But all of these things can play a role in deciding between this and a short put. So now let's do that short put. Okay. So if instead, let's switch gears and think about selling this put. We sell the 21st of March 245 put for $7.35. Is that a bullish or a bearish trade? Typically, a trader is looking for here for the stock to go up or for the contract to just expire worthless. So we have a bullish bias. Yeah, selling puts is a bullish bias. Do we have to own the shares in order to sell a put? No, don't have to own the shares, but we have the obligation to own the shares. Therefore, if we were to do this in an IRA, I wonder if we go here, let's route this to our IRA account. And let's sell a put. And let's click confirm and send. How much is it telling me I'm going to be tying up in buying power? In other words, how much cash do I have to dedicate to this? $23,795. Doesn't that sound an awful lot like what we saw over here? That's effectively within a fraction of a percentage point, an identical scenario. Same amount of cash tied up. What's the maximum loss on this trade? It's $237.95. The maximum loss on our covered call was $237.05. Little bit of difference there, but not a whole lot. What's the maximum gain on this trade? Well, if we're collecting 705, right now, actually, let me do this to make it more accurate to what we discussed as our trade example. Let's dial this up. Let's put this at 735. Remember, we tried to capture that moment in time. There we go. Let's now click confirm and send. There we go. Yeah, that makes our cash even closer to the original requirement. Maximum profit, even closer, $7.95 versus $7.35. Max loss, even closer, $23,765, $23,705. This is pretty much the same trade. How much is the commission? 65 cents, 65 cents. Where's the break even? We had a break even of 237.05. This trade break even of 237.65. There's a distinction of pennies here. So you might be thinking, ooh, with most of these, the covered call is looking like the superior trade. It's kind of the way it's working out with this example. But if we did 100 examples on 100 different stocks, guess what's going to happen to those distinctions? They're going to start to bleed out. The distinctions are going to be not so much distinctions at all. Instead, they're going to stand out as extreme similarities. So what have we missed here? Maximum gain, maximum loss, break even, cash requirement, commission, ownership, bias. Those are all effectively the same. Okay. Well, what about what happens at expiration? If we go back to our chart, let's assume we sell that 245 put, and the stock is above that. If we're up at 250, and another trader has the right to sell us shares for 245, are they going to do it? They're going to say, no, Cameron, keep my premium. I'm not selling you the shares. So, hey, we kept the premium, that's max gain, but we don't have the stock. What if we're below the strike? What if we're down here at 240 at expiration? Someone has the right to sell shares to us for 245. Well, we're required to buy those shares at 245. We do it. We keep the premium, but we are short of maximum gain, but we do own the stock. That sounds like the same outcome or so similar to be almost indistinguishable. So here's the bottom line. Covered call versus short put, which one is better? They're really, really similar trades. Now, that's not to say that there are no distinctions. There are a few distinctions, three that I want to highlight. First of all, what if we're not doing these trades in an IRA? Instead, we're doing them in a margin account. Well, the margin requirement on a short put is less than the margin requirement on a covered call. So if we were to redirect this short put, let's confirm this, like we're sending it into our margin account, there's about a $4,800 requirement. It's generally about 20% of the maximum loss. That's a kind of a rule of thumb there. If instead we were doing a covered call, let's buy that covered stock, is what Thinkorswim calls it, and we put that in our margin account, well, we have the 50% requirement for the shares minus the premium on the call. It's going to be about 3 times as much, 2.5, 3 times as much buying power that's used up in a margin account. So there's a distinction there. Now, that doesn't say that one trade has a better chance of making or losing money. Actually, the probabilities work out just about exactly the same. As a matter of fact, the probabilities of success or failure on these trades, with the exception of break even, are identical. Because max gain being above the strike, that probability doesn't change whether it's a covered call or a short put, if it's the same strike price. Max loss, that can be different by degree. Break even, same deal. It's the same as max loss. Let me see if I missed any questions here. I don't think so. Now, there's one other final distinction, and that is the way that for some traders, the way they structure the trade. Some of you are saying, yeah, Cameron, this is all fine and good, but with my puts, I tend to sell those below support. And with the calls, I tend to sell those above resistance. That's not uncommon. So that can be a distinction. Strike selection to reduce the probability of assignment can be different depending on trader preference. But really, if we're comparing, sorry for the pun, somebody else pointed this out, but apples to apples, if we're comparing the same strike on the same stock, covered call versus short put, they are very, very, very similar strategies. So it really comes down to trader preference. Okay. So what I'm going to do here is, David, you like that comparison? I'm going to go ahead with the short put because we already have a bunch of covered calls in our portfolio. Let's go to the 245 short put. And as a matter of fact, I'm not even going to do the 245. Let's go below our support. I wonder what we get down here at maybe 232 and a half. 232 and a half, 235, is that still below? Yeah, that's still below. Let's go for 235. I'm going to click on that. Maybe we can get 295-ish. Let me hide this left column now. We'll just do one put for this example. Looks like it's trading between 298 and 3. You know, last week we didn't get a fill. I'm going to drop that down to 295. See if we can get a fill here. And let's confirm and send that trade. Okay, here we are. Break even at 232.05, max profit 295, max loss. There's our commission. Selling that April 21st of March, $25 put at a 295 limit. Send that off. See if we can get filled. Yep, this time we're filled. Okay, that's good. All right, guys, but we've accomplished everything I set out to do. I hope you enjoyed this discussion. I thought that would be a great topic. Let's tackle covered calls versus short puts and really peel back the layers of the onion and discover just how similar they are. They might even be considered pretty similar, not identical twin strategies, but darn close. So we're going to continue trading these strategies into the future. We're going to talk about the management of these trades. So I hope you'll join me again in future webcasts. But between now and then, make sure that you've done yourself a favor. If you haven't subscribed to our Trader Talks channel, go down and click on that subscribe button right now. It doesn't cost anything, but it subscribes you to the channel. And the channel is where we host our previous webcasts. And you can also join our live streams here. Also, follow Barb and me on X. You can follow Barb at Barb Armstrong CS. You can follow me there at Cameron May CS. If you have an account, give us a follow. That doesn't cost anything, and it only takes a moment. I'm just scanning back through the chats. I didn't see a survey, and I'm just triple checking. Yep, looks good. But I also want to thank everybody that's already clicked the like button. That's always appreciated. If you watch a webcast and you like what you heard, if you learned something new, click that like button. It gives applause to your presenter for their efforts. It also boosts that presenter's webcast in the YouTube algorithm, helps more people find the webcast and helps more people learn these sorts of things. So everybody, thanks for giving me your time today. I will see you in a future webcast. I'll also look for you on X, and by the way, I always like to see how many people, 49 people have already clicked the like button. Thank you for that. Very much appreciated. But I'll look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.